If you're interested in growing your wealth, you've probably heard a lot of different opinions about the stock market. In this video, we'll be discussing the top 10 myths about investing in stocks and why they're simply not true. From the misconception that stocks are only for the wealthy to the belief that investing in stocks is just like gambling, we'll be setting the record straight with facts and research-backed evidence. Whether you're a beginner or a seasoned investor, you won't want to miss this video. So, grab a pen and paper, take some notes, and let's dive in. Myth number 1. Investing in stocks is like gambling. While it's true that investing in stocks carries some risks, it's not the same as gambling. Gambling is a game of chance where the odds are typically stacked against you. In contrast, investing in stocks involves analyzing a company's financial performance, competitive position, and growth prospects to make informed investment decisions. Investors can use a variety of techniques to evaluate stocks, including fundamental analysis, technical analysis, and quantitative analysis. These techniques allow investors to assess a company's financial health, management quality, and market position, among other factors. By doing so, investors can make more informed decisions about whether to invest in a particular stock. Moreover, investing in stocks is a long-term strategy that aims to generate wealth over time. By investing in high-quality companies that have a competitive advantage, investors can benefit from the power of compound interest and growth. Myth number 2. You need a lot of money to invest in stocks. Contrary to popular belief, you don't need a lot of money to invest in stocks. In fact, you can start with as little as $10 or $20, thanks to the rise of fractional share investing. Fractional share investing allows investors to buy a portion of a share, which makes it possible to invest in high-priced stocks without needing a lot of capital. Moreover, many brokerage firms now offer commission-free trading, which means you can buy and sell stocks without paying any fees. This makes it easier and more affordable for beginners to start investing in the stock market. Myth number 3. You need to be an expert to invest in stocks. Investing in stocks may seem intimidating and complicated, but you don't need to be an expert to get started. There are plenty of resources available that can help you learn about the stock market, including books, websites, and online courses. Many brokerage firms also offer educational resources and tools to help beginners learn about investing. For example, they may provide access to research reports, stock screeners, and investment calculators to help you make informed decisions. Moreover, there are different types of investment strategies that you can use to invest in the stock market. For example, you can invest in index funds or exchange-traded funds, ETFs, which provide exposure to a diversified portfolio of stocks. These investment vehicles are designed to track the performance of a specific market index, such as the S&P 500, and can be an easy way for beginners to get started with investing. So, don't let the myth that you need to be an expert hold you back from investing in stocks. With the abundance of resources available and different investment strategies to choose from, anyone can start investing in the stock market. Myth number 4. Stocks always go up. While it's true that stocks tend to increase in value over the long term, it's not always the case that stocks go up. In fact, the stock market is subject to volatility and fluctuations, which can result in significant losses for investors. Investors need to be aware of the risks associated with investing in stocks and should diversify their portfolios to minimize their exposure to any single company or sector. This means investing in a mix of stocks, bonds, and other assets that can help reduce risk and increase potential returns. Moreover, investors should have a long-term investment strategy and avoid making impulsive decisions based on short-term market movements. By staying focused on their investment goals and avoiding emotional reactions to market fluctuations, investors can weather the ups and downs of the stock market. So, don't believe the myth that stocks always go up. While the stock market tends to increase in value over the long term, it's not immune to volatility and fluctuations that can result in significant losses. By diversifying your portfolio, having a long-term investment strategy, and avoiding emotional reactions to market movements, you can reduce your risk and increase your potential for long-term returns. Myth number 5. Investing in stocks is only for the wealthy. Many people believe that investing in stocks is only for the wealthy, but this is simply not true. In fact, anyone can invest in the stock market, regardless of their income level. Thanks to fractional share investing, investors can buy a portion of a share and start investing with just a few dollars. This makes it possible for anyone to invest in high-priced stocks, such as Amazon or Google, without needing a lot of capital. Moreover, many brokerage firms now offer commission-free trading, which means that investors can buy and sell stocks without paying any fees. This makes it easier and more affordable for beginners to start investing in the stock market. Lastly, many employers offer retirement plans, such as 401k plans, that allow employees to invest in the stock market through payroll deductions. This means that you can invest a portion of your salary in the stock market, even if you don't have a lot of disposable income. So don't let the myth that investing in stocks is only for the wealthy hold you back. Anyone can start investing in the stock market with just a few dollars thanks to fractional share investing and commission-free trading. Additionally, if your employer offers a retirement plan, take advantage of the opportunity to invest in the stock market through payroll deductions. Myth number 6, stocks are only for short-term gains. Many people believe that investing in stocks is only for short-term gains, but this is not true. While it's true that some investors buy and sell stocks quickly to make a profit, this approach is not the only way to invest in the stock market. In fact, many successful investors take a long-term approach to investing in stocks. They invest in high-quality companies with strong fundamentals and hold their investments for years, even decades. By doing so, they benefit from the compounding effect of returns over time, which can result in significant gains. Moreover, investing in stocks for the long term can help investors weather short-term market fluctuations and volatility. By staying focused on their investment goals and avoiding emotional reactions to market movements, investors can ride out the ups and downs of the stock market and benefit from long-term gains. So don't believe the myth that stocks are only for short-term gains. While some investors may buy and sell stocks quickly, taking a long-term approach to investing in stocks can result in significant gains. By investing in high-quality companies with strong fundamentals and holding their investments for years, even decades, investors can benefit from the compounding effect of returns over time. Myth number 7, you need to follow the news to invest in stocks. Many people believe that in order to invest in stocks successfully, they need to constantly follow the news and keep up with the latest market trends. While staying informed about the stock market can be helpful, it's not necessary to be a successful investor. In fact, investing in stocks is more about investing in high-quality companies with strong fundamentals and growth potential than it is about following the news. By doing your research and analyzing a company's financials and growth prospects, you can make informed investment decisions that aren't based solely on the latest news headlines. Moreover, trying to time the market based on news and market trends can actually be harmful to your investment returns. Short-term market movements and news can be unpredictable, and trying to make investment decisions based on them can result in poor performance. So don't believe the myth that you need to constantly follow the news to invest in stocks successfully. While staying informed about the stock market can be helpful, it's not necessary to be a successful investor. Instead, focus on investing in high-quality companies with strong fundamentals and growth potential. By doing your research and avoiding emotional reactions to short-term market movements, you can make informed investment decisions that can result in long-term gains. Myth number 8, you need to buy and sell stocks frequently to make money. Many people believe that in order to make money from investing in stocks, they need to constantly buy and sell stocks to take advantage of market movements. However, this is not true. In fact, frequent buying and selling of stocks can actually harm your investment returns due to transaction costs and taxes. The key to making money from investing in stocks is to focus on the long-term growth potential of high-quality companies. By investing in these companies and holding onto your investments for the long term, you can benefit from the power of compounding and potentially generate significant returns. Moreover, frequent buying and selling of stocks can lead to emotional investing decisions and trying to time the market, which can result in poor investment returns. By taking a long-term approach and staying disciplined in your investment strategy, you can potentially generate higher investment returns over time. So, don't believe the myth that you need to buy and sell stocks frequently to make money from investing. Instead, focus on investing in high-quality companies with long-term growth potential and holding onto your investments for the long term. By doing so, you can potentially generate significant investment returns and avoid the negative effects of transaction costs and taxes. Myth number 9, investing in stocks is too complicated. Many people believe that investing in stocks is too complicated and requires a lot of knowledge and expertise. However, investing in stocks can be simple if you have a basic understanding of the stock market and a long-term investment strategy. One of the easiest ways to invest in stocks is through index funds or exchange-traded funds, ETFs, which track a specific stock index or sector. This allows you to invest in a diversified portfolio of stocks with minimal effort. and without having to pick individual stocks. Additionally, there are many online resources available to help you research and analyze stocks, such as financial news websites and stock analysis tools. By using these resources and doing your own research, you can make informed investment decisions that are not based solely on speculation or hearsay. Moreover, there are many investment platforms available that make investing in stocks simple and accessible. These platforms often offer commission-free trading and low account minimums, allowing you to start investing with as little as $1. So, don't believe the myth that investing in stocks is too complicated. While investing in stocks does require some basic knowledge and research, it can be simple and accessible with the right tools and resources. By investing in index funds or ETFs, doing your own research, and using investment platforms, you can make informed investment decisions and potentially generate significant returns over the long term. And that's a wrap on our video about the 10 biggest myths about investing in stocks. We hope you enjoyed this debunking journey and have a clearer understanding of what's true and what's not when it comes to investing in stocks. Remember, don't let these myths hold you back from achieving your financial goals. Keep learning and make informed decisions based on research and facts. If you found this video helpful, don't forget to give it a thumbs up and share it with your friends. And if you haven't already, hit that subscribe button to stay tuned for more informative content just like this. Thanks for watching, and we'll see you in the next one.